first time we're getting an actual kind of price target almost on what kind of price cap they're looking at, $40 to $60 on Russian oil. How much of a difference could that make to the commodity complex?
Well, if you're talking about Russian oil actually being sold at that price as opposed to being cut off, the difference might be relatively minimal because the idea of the whole price cap is to keep the same number of molecules flowing and to essentially cut the revenues to Russia. That means that overall, you'd have essentially less stress on the oil market to the upside. On the other hand, the risk of that, is that you could end up with Russia saying no, in which case you could have considerable upside lift to the crude price globally, at least for a little while.
Do you think it is possible to do what they are suggesting, Kevin? What are the logistics around all of this?
Well, the revenue equals price times quantity, but it works two ways. And so the idea is innovative. It deserves, I think, applause for its creativity. The challenge in implementing it can be quite difficult. Part of the problem is that you have buyers who have to be persuaded, if they're choosing for their own energy security, between the Russian barrel at whatever that delta Russia might want above that $40 to $80 price band you just mentioned, and conforming with allies, it could be a tough choice. It could be very easy for Moscow to divide allies by essentially offering an increment to the band.
All right, well, let's bring in the story of natural gas here. We know there are issues right now in Europe naturally pushing the prices higher. Today, natural gas prices they were seeing a little bit of a relief, but they're even already still rallying, even in the face of Germany perhaps taking some of the pressures off, trying to really accommodate this part of the market. But I have to ask, when you're looking at an environment where in the long term, the United States might start to export more and more natural gas, what kind of time horizon are we looking at for that to really materialize?
Well, the problem with this particular crisis, so many ways like the 1970s oil crisis, is that pipes and ports are different things. You can move oil on the open sea much more easily than you can gas because of constraints on the infrastructure front. Building an LNG receiving facility, you can move FSRUs, floating storage regasification units, in place within a period of months to years, and that's happening. Europe is loading up on FSRUs as fast as they can. But actually building receiving capacity, enduring receiving capacity, multi-year timescales, 3 to 5, 2 maybe at an existing site, and building liquefaction capacity is a 5-year horizon as well. A lot of the cargoes being contracted for now will be for delivery later in the decade. But the difference also in this crisis is that once the pipes are shut, they're shut. So you're going to need new supply from somewhere. That might still be worth doing.
Yeah. Do you think they will be shut? Is that your central case at the moment? Do you think the Russians do turn the gas off?
Well, I think it a lot depends on the duration of conflict, the nature of what post-conflict settlements look like. There's a story that this is ultimately to give Ukraine the greatest purchase in negotiating a settlement, but sanctions could come off with settlement. But there's another flavor of that argument, which says sanctions shouldn't come off until the last Russian territory is ceded back to Ukraine. That could be a much longer cessation of supply.
Kevin, let's switch from Europe to perhaps China as well. I'm curious about the deceleration in China as the second largest oil consuming nation in the world and the ripple effects there. I mean, China is still growing. Let's not kind of shield that. But I'm curious where that factors into the equation as we talk about the bull case for oil.
Well, yeah, we've been talking a lot about the supply side here and there. Ecuador shutting down 300,000 barrels per day. The idea that the Norway strike might be 125,000. And meanwhile, we're talking about 500,000, 1 million barrels per day of delta when China is offline in cities due to COVID or economic weakness. Obviously, biggest oil importing country in the world makes the biggest dent. We can think a lot about the global picture in terms of what supply does in response to price. For importing economies with a lot of control over the means of production and the ability to modulate demand, you can get very big differences, even in response to prices that might make other economies more static in their consumption. So we've seen what happens. When China shuts down, oil can weaken considerably.
Kevin, let's talk about the crack spread. Everybody seems to know about the crack spread now. Everybody's getting very excited about refining capacity. Oil prices come down. How quickly does that translate into lower gasoline prices on the forecourt?
So there's a lag in a lot of markets between the wholesale price and the retail price. It gets a lot of political attention because it exists at a time when consumers want price relief. If the structural problem you're looking to solve is a shortage of refining capacity, though, that's not something that's going to be solved right away. You have U.S. refiners really the largest refining sector at highest quality in the world, running flat out. You have some new capacity coming on later this year, more for next year, but running much harder isn't much of an option. In the end, if you run refineries too hard and forego maintenance, you can have opportunities for interruptions in supply that you would like to avoid. So there's a lot of risk associated with that too.
Kevin, very quickly, about 30 seconds here, I have to ask, how low can oil go? How high can oil go? What kind of range are we looking at?
Well, you can look at the EIA's forecast based on futures markets, and it's always a yawning gap that you could drive, a tanker through. But the answer, I think, has a little bit to do with the fact that sanctions have yet to fully phase in. If the world is really going to be tightening on supply as much as it plans to do, I think there's still more room to the upside to be considered, and also some breaks with regard to the downside.